Happy Monday. I'm in a different studio. You can tell the background is different. It's still one-on-one. Greg Sher with you here on this Monday of November. It is the 17th. We are almost there. We're like right around the bend here, and I'm really excited to talk to a very special guest, as always. Jen McGuinness. Is it Lubbert? Lubbert? You got...
How about we just go with Jen?
Oh, my goodness. I love that. Chief Executive Officer of Pivot Financial. You have been in the mortgage game for so long, many years. You've covered cradle to grave, soup to nuts, every component of the mortgage industry, which makes you a unicorn. And it's understandable why you're on stages all the time and someone that the industry turns to in particularly moments of questions and moments of uncertainty. And we've got plenty of both of those at the moment. I am at corporate today in Baltimore, and I have someone that just walked in here. This is live. This is, you will not believe I have a celebrity in here with me. Dr. Rick Rock is at corporate today. This is unbelievable. I had no idea he would be here. He all of a sudden just showed up.
So it's 2-on-1, not just 1-on-1.
Yeah, we're going to change it to
dude, I welcome it. Pull up a chair. Let's do it.
I mean, this guy's a total celebrity, as you probably know, and he's probably here to take my job, which will make at least half the audience happy. The other half wants nothing to do with that possibility. Believe me.
Jennifer, good to see you. It's great.
Always good to see you.
You're doing great work.
Thanks, Rick. You too.
All right, Rick. All right, take care, buddy.
Take care.
Hopefully you'll still be here. I'll see you in a minute. That was a nice surprise. All right, Jennifer, let's jump right into it. We have so many topics to cover here today. Non-QM, secondary. Does it pay to be anything but in servicing these days? Like, can you survive without servicing? You've got an expansive background in the secondary market, so I'm curious to know your take on that. Before we get into that, though, I'm going to flip it a little bit because I had third on the list talking about FICO and VantageScore, and there's been a development as recently as today along those lines. So let's jump right in. What do you know, and what have you learned?
Yeah, so in late September, Fannie and Freddie had announced that they were going to commence making changes to the disclosures, the loan level files, et cetera, for the UMBS securitizations that are generally combined Fannie and Freddie loans. As of today, they are releasing those revised disclosures and whatnot that will allow for Vantage or FICO Classic to be provided for those deals. That's active today. I actually did a post about it on LinkedIn today with links to, the guidance to be able to access the new files, et cetera. So that's as of today. I think the most interesting thing in there to me was that they're alluding that, and you'll see it if you read them, that for bonds predating December of 2025, Vantage will have a 7777 notation in the data file, which means not applicable. And then going forward, it can be available. And then, FICO or Vantage will have what's called a 9999 code as just not there. So that alludes to the fact that we may see agency bonds as soon as December with loans with VantageScore.
Wow.
But
well, I was under the impression that we're not going to be in a position to have that the agencies would not be purchasing loans with the VantageScore until, someone in the NBA told me as late as the fourth quarter of next year, possibly. I think the guests have been all over the place. Does that move this time frame up to as soon as a month?
Well, you're not wrong. They originally announced like a pause, right, for implementing this, and then came out in September indicating Q4 of 25. So, I don't know because I don't recall seeing exactly what the NBA had said, so I'm not going to speak to that. But the one other thing I would say that's an interesting development as well that we've seen in the last week or so is that FHFA is allegedly also in finalizing talks with FICO to allow for FICO 10T to also be offered, which I think is actually a more fair comparison to Vantage 4.0 than FICO Classic, because FICO Classic is an older model, right?
Yeah.
So I do think that would make a lot of sense.
Well, but here's the thing, and so you can uncover this for me. I know that when the Credit Competition Act was passed in the last Trump administration, that called for the FHFA to find another option for credit beyond FICO, that VantageScore, they put up, I think, 45 million records up against the Vantage 4.0 to see the efficacy and how these loans would have performed based on that model. FICO hasn't done that yet. They were supposed to. They're well beyond a year. It's been years that they were supposed to submit that information. Do you see any scenario where that's bypassed and they could just be approved?
No, but it's my understanding they have produced that information because they wouldn't be able to finalize those discussions with FHFA without producing that information. It was part of the process. So,
all right, so that must be fairly recently then.
Yeah, I mean, and like I said, it's been probably the last week or so that we've heard about them possibly finalizing those discussions. So I think, that's one to watch.
Okay, well, let's talk about FICO for a minute. What do you think of them? What do you think of the fact that their profit margins are more than 3 times the profit margins of the 3 repositories? Is that just capitalism, or does the CEO need to be making $65 million in a year that they crush it when Tim Cook's making, 10 million?
Well, here's my thing. I am never going to comment on executive comp. I mean, we just had the $1 trillion Elon Musk, comp package get
insane.
So I'm not touching executive comp with a 10-foot pole. That's too long of a discussion for this podcast.
Yeah. All right. Well, let's just talk about FICO then. Let's talk about FICO. I mean, you certainly can comment on 700% price increases and what you think about that.
Yeah, I think that there are components to the production of the FICO score, and I think they need to be broken down, right? I think that there's been a lot more transparency that's come out as to exactly what goes into the manufacturing of the tri-merge. And it's not only the cost for FICO, as I'm sure you guys know. I think they do, and I've posted about this before, Greg, and you and I have gone back and forth on it. And, I think that you need to tease out the parts and see where the actual most expensive components are coming from. I think that's one of the reasons why FICO is offering this FICO Direct product with regard to, seeing their component, which is more I think it's $4.95 plus a $33 charge on a closed loan. And off the top of my head. And, I think that that's important too. So I'm not, in order to do what you're asking, I need to go do a regressive analysis and component parts of exactly where the cost deviations came from, because they were being billed at a place, even though the costs were coming from multiple places. So, I think, and I'm happy to do that analysis. I think it's worthwhile for people to understand that.
Are you going to do it for free just because we're such good friends, or are you going to bill me?
I actually think it's something that should be done. And I don't bill anybody for things I'm curious about.
Oh, wow.
So curiosity.
Oh, wow. Okay, good. Well, I'm going to go over all the list of things I need help with, and I want to just check the box of things you're curious about.
I'll let you know if I'm curious about them, and then we'll go.
I'm loving this relationship. It's really amazing.
Works both ways. Yeah, definitely.
Yeah, it really does. So, I mean, FICO, they've been around for a minute, and certainly I think that we need the competition, but it's so convoluted. I want you to, if you would, give us your thoughts on the fact that VantageScore is owned by the 3 bureaus. FICO can't produce a score without the data that the 3 bureaus have. I mean, are we just taking one web and creating another one, or could we maybe come out on the other side of this with real clarity and transparency?
Well, I think that that's part of the question, right? That, I keep discussing with people, which is through a joint venture, Vantage is owned by the 3 bureaus. And those same bureau credit reporting information is used to create Vantage4 and FICO. But I think there is a possible conflict of interest that nobody is focusing on. And that is, what is the probability that Vantage will actually correct, negate, or change any of the data from the credit bureaus if they are seeing issues with that data when in fact they're owned by the same company? It's very well known that part of the FICO model is to actually look at the data, see if it makes sense that comes from the credit bureaus, data normalize that data. At times, if it's not normalized or looks like bad data, they actually take it out before they run the FICO model. And I think that that's a question that needs to happen. The other thing is, what precludes the bureaus, as Vantage is more and more popular if that happens from just pricing FICO out of the market for as it pertains to the cost of the actual credit repository data that's necessary to run the FICO score. So I think those are things and items that really need to be addressed and answered as well.
Now, let me play devil's advocate here and ask a question. Do we need competition, or do we just need FICO to behave themselves? In other words, are we creating more problems, more layers, more difficulty by introducing a whole new batch of variables when we've kind of done okay with this FICO thing for a really long time? In other words, if we could get FICO to behave, be more transparent, put a governor on their increases, could that be the lesser of two evils?
I mean, look, I think that, FICO has been tested for a very long time, right? I would not personally, as an investor, blanketly change today to Vantage. I wouldn't do it as a lender either until I'm done teasing out the details between the two models, right? And I think one of the biggest things is, 33 million people are allegedly going to be scored that have never been scored before. And I think that's one of the biggest things that Vantage is hanging their hat on. And you and I have talked about this before. Just because you can score a person doesn't necessarily mean that's going to mean they're going to all of a sudden be able to get a mortgage.
Well, they say roughly 5 million of them will have a FICO of 620 or above, but then you run into the question, well, if you have the choice, if you can select FICO or select VantageScore, it could be a race to the bottom because people might just go and try and get the higher score. And what if that's VantageScore and we have no real history beyond those records that were suppressed to know how they're going to perform? And so I'll pivot into a secondary question because
one more thing there.
Yeah.
But I think we have to be careful there. So to your point, let's say somebody gets the FICO and the VantageScore. One is absolutely going to fail and one's going to pass, right? There are certain aspects of reps and warrants, certain knowledge-related items as it pertains to the manufacturing of loans, the issuing of securities, et cetera, that if there is actual knowledge of possible inherent risk, you are supposed to proceed in what would be the right way. Take that as you will.
But that's ambiguous, though. You're not going to know. You're not going to know that. I mean, that's all that is a model. I mean, FICO's got their black box. Vantage is going to have their orange box. Whatever. I know that these tests have been done, but the question I was getting to is, we're not really going to know how the cake was cooked until we start tasting it. And the way we're going to taste it is when we look back after 3 years, 5 years, 8 years and see how these loans perform. And so isn't there just a layer of inherent risk? Now, you can do all the testing and A/B modeling and suppressing you want. We're not really going to know until we see how these loans perform.
Yeah, and then the question is going to be, is it really the credit score that really told us how the loans are going to repay, or is it the characteristics of the underwriting, right?
Yeah, all right. Well, that's a great pivot into my next point. I'm going to move this along. I hope you can forgive my style. I know I'm pushing here, but you've got a lot. You have a lot to talk about. I want to have great pace here. So you mentioned underwriting, you mentioned loan performance. I want to talk about non-QM loans because I have been pretty vocal about my concern around non-QM loans. And it's not that they're bad loans. It's just from the lens of all the exuberance around people running into the fire, the non-QM fire, which right now is good. It's a good fire. It's keeping people warm. The question is this fire going to build into a 9-alarm fire at some point? I have heard you on other shows say that, non-QM, if used properly, is a great tool. And I agree with you. Just like I heard you say that option arms were a great tool at one point. They were abused. Subprime was a great. So yes, I understand that. Still, there is a history of sort of a frenzy of people wanting to do more and more and more and more. And then they get more and more and more creative around the product line. And before you know it, we're in the middle of a shitstorm. So what's going to prevent non-QM from realizing the same fate?
Well, I think there are agency and non-agency products that have actually felt that, right?
Fair.
And I think everybody forgets that why are the GSEs in conservatorship? They were going as big a sideways as Lehman did back in, the 08 scenario, et cetera, right? So I think that there's a lot of vilification of non-agency, non-QM, et cetera, but there have been just as big an issue in agency historically as well. Now you're going to go to there's the implicit guarantee and all that stuff. Well, that's why they're in conservatorship. But with that said, to your point, non-QM when applied properly without ridiculous guidelines, I do not see as being a large risk issue. Even with those loans that have been blended life to date in non-QM securitization, losses have been less than 5 basis points, cumulative. Okay, so even with differentiated guidelines, differentiated LTVs, FICOs, DTIs, etc., and that's not in all types of loans. There is a correlation that FICOs below 660 generally do have, more delinquency. There's also, so for example, 10% of the average versus 2% of the average for 760 plus FICO.
Yeah.
As an example, cumulative defaults for non-QM have been 3.6%, where the agencies sit somewhere between, call it 1% and 2%. So is it a little bit different when you can have certain alternative documentation underwrites? Yes, but the nuance is not 2% to 25%, right? It's still single digit numbers. Also, there's been a significant correction. The highest delinquency level on non-QM was at the height of the pandemic. It was in excess of 5%, and that's equalized, right? And we have not seen that continue. So I do think they are not as risky as some believe. Now, I've said this before, and I know you've watched some of the other podcasts. The manner in which you underwrite loans, not only your FICO score, not only your LTV, et cetera, matters, okay? If you start doing silly non-QM loans, or quite frankly, silly agency loans, you have a much bigger risk of default. But overall, the credit characteristics of non-QM that have been securitized to date,
Yep.
right? Although they've fluctuated by around 5 to 10 points of FICO, right? So is agency. And I think that that's an important comparative to see. And I think, look, if you're going to go and do no doc loans that are allegedly called non-QM, those are not non-QM loans. Those are truly subprime loans, right? The non-QM assets all have documentation types. There are no doc non-QM loans that are securitized today in MES.
Got it. Well, I think that I know that at NFM, my company, that the lion's share of the non-QM we're doing, and we're doubling down like everybody else. We hope to do 1 billion of these loans. We have a great, robust internal department doing these. Mm-hmm. About 70% of them are DSCR loans, yep. which oftentimes are which oftentimes are qualified based on the rents that are able to be charged. Right. And so you've got, cash flow and things like that. And in a market where rents are pretty healthy, I don't think they're going to the moon anymore, but they seem to be, stable-ish, right? In an environment where the LTVs are wonderful. Like, what would need to change the way you look at the danger here? Is it, give me the combination, the gen picture of the combo between, rents going down and LTVs going down. Where is that inflection point where we have to go, whoa, wait a minute, maybe we need to slow down the bus?
So I'm going to touch on 2 points here. First and foremost, I helped bring the DSCR loan to market when I was at Colony. And I think that's important. The original DSCR loans were designed to be either a stabilized rental product with a lease in place, or to be the refinance of an acquisition line of credit, again, with lease in place. Over the course of X amount of years, since 2015, when they were brought to market, you have seen some changes, such as a purchase could now have no lease in place and go off a market lease assessment, market rent assessment, et cetera. So not all DSCR programs are created equal. What we've seen in a shift in that product, and this is going to answer your question, Greg, is when it first came out, you needed a DSCR of at least one being that 100% of the cost to operate, the mortgage, taxes, insurance, et cetera, the turns on the property would be covered by the cash flow of the underlying rental cash flow. Now you've seen a lot of products take that DSCR ratio lower, some as low as 50%. And the guidelines then need to account for where is the rest of that cash money to actually operate that asset coming from. So I would say when you are a lender sitting in the chair of deciding which products you're going to originate, you need to think through these completely. So if I'm going to originate DSCR products with lower than 1 DSCRs, what's my compensating credit risk offset from an underwriting perspective to know that that borrower has that other additional 50% of the money that it takes for that asset to perform every month, right? And over the course of the entire year for the duration of my loan, right? So I think that's important. With regard to what would have to shift in order for there to be an issue in non-QM generally, I think, again, you want to watch the manner in which each of the allowable entities that invest in these loans manufacture those loans and make a proper risk-based decision as a lender as to which products you'll originate. You know, a step out of agency, which actually is an overlay to DU or LP, is very similar to what most people are 92% of the time manufacturing to begin with. If all of a sudden you're going into 100 LTV, 12-month bank statement loans, you may want to reconsider that.
All right. So you did not really answer my question, but although you gave me some unbelievable color on this, so thank you. I didn't.
So I can answer it.
Well, it was, very specifically, what is how much of a depreciation in existing home sales does there need to be, right? And a reduction of rents, given the fact that DSCR is the prevailing factor in these loans. What is that point where we need to go, wait, maybe we should look harder at this? Is it a 10% decline in values?
So it's not going to be the same nationally, right? So
that's right. Yeah.
You have certain states now that are actually precluding investors from being able to bid on properties until they've been on the market for a certain period of time, right? Maryland's a good example, right? So an investor is generally going to look for, a 6 to 12% at a minimum, depending upon the type of investor rental yield, most over 8.5, right? So when you take that into consideration, if you watch the national rental yields across the nation and you watch what's going up, down, leveling out, et cetera, you're going to start to see less investor appetite where rental yields are going lower than those numbers.
Okay. All right. Thank you. I'm going to pivot now to the FHFA and Director Pulte, because I've got 4 ideas that he rolled out, and I want to get your reaction on them. We've already talked about FICO and VantageScore, and the manner in which he made the announcement, shocked a lot of people. I'm sure it shocked you. Hey, we're ready to take VantageScore today, when in fact it was a lot more complicated and continues to be very complicated. There was the LLPAs that he was working with Barry Habib on. I think we were all hoping that there'd be some relief for first-time home buyers. It turns out, according to Housing Wire and Barry Habib himself, that the focus there is on second mortgages and refis, which that doesn't help first-time home buyers. There's the 50-year mortgage idea that came about 3 weeks ago. And then about a week ago, this idea of assumable mortgages. I don't know where to begin to unpack this, but when I read that to you, what are the thoughts that come into your head that you care to share with my audience?
Well, first and foremost, I think, the LLPAs that they're planning to adjust first are actually for second home and investment properties, right? Which, to your point that I've seen you talk about on LinkedIn a lot, doesn't really help us from a home purchase perspective, right? But what it does do is it gives the GSE the opportunity to attempt to grab more production that today they're not doing in a big way. A lot of that, to your point with DSCR and certain other products, really is living in the non-QM universe. So the question is, are they creating LLPAs that are really going to help home ownership, or are they creating LLPAs to actually increase the types of loans that are coming into their balance sheets and also, their revenue production, their financials, et cetera, right? So I think that's the first one. It's a good question. I think you brought up 50-year mortgages. I mean, that doesn't excite me in the least, because at the end of the day, the duration of a mortgage loan is going to get priced in. The rate on a 50-year is going to be higher than a 30-year. We saw that with 40-year mortgages that happened previously. Once you actually increase those interest rates, I also put up an example on LinkedIn if anybody wants to go look at it. I used a $350,000 mortgage, and the interest rate is probably going to be at least a point higher between a 30 and a 50 year if it ever gets done. But I think there's other risk factors that need to be taken into consideration. And as you know, the mortgage business is very focused on the fact that the first-time home buyer's age has increased significantly, somewhere between 37 and 40 years old, while the average age of death for a United States citizen is 79 and a half. If all of a sudden you give a 50-year mortgage to a 40-year-old individual, and our average age of death is, 70, I think it's 75 or 76 and a half, how do we price in the fact that a borrower may die before they would pay that mortgage off? On the inverse, most people don't stay in the house that long, right? Generally, people stay in the home or mortgage 7 to 11 years. We saw a little bit of an extension to 13 years at one point during some of the uptick in the rates on averages, but that's really equalized more to be, call it 7 to 11 and a half, 12 years. And, the problem I foresee is if you go with the 50-year mortgage, you're going to be only really moving into your principal pay down much later. And then the borrower has to really think about, if I'm going into this house with a 50-year mortgage and I don't plan to stay here, then I'm going to be leaving this house with only the equity differential if my home price goes up or goes down. And, what's that going to look like when I am going to depart? And I've said this before too. It's great if we want to talk about all this, but one of the intrinsic problems, in my opinion, in mortgage is lack of structured products today. And I don't mean securitizations. Today, we have some ARM loans and the rest of them are 30-year fixed, okay? And when you think about that, that's not how every borrower is going to behave. If I'm being relocated to a different state and I know I'm only going to be there for 5 years, but I think it's better for me to buy a house than rent, right? I don't care if I have a 30 or a 50-year loan. And what might even be better for me is an interest-only loan. And interest-only loans are not villains, okay? So I think we need to get back to the good parts of history, which is having products to serve what a borrower is really looking to achieve based on how long they believe they're going to be in a property. Okay.
Yep.
Let's see. The next thing you brought up was portable mortgages.
Yeah.
Assumable mortgages for loans that are allowed to be assumed, which are not the GSE product, right, have not really had significant traction on assumptions because of how slow, candidly, and how annoying and difficult it is for the servicer to underwrite those loans. So it's never gotten really big traction. I think the latest that was posted on X was portable mortgages, which is really a big thing in places like Australia and the UK, where you could take your same interest rate to a new property. And, but it's not like you take your mortgage from Florida to New York and just overnight make it happen. Loan gets re-underwritten and, income gets re-underwritten, house gets valued, collateral gets transferred out of that loan to the new loan. And as, the market continues to stabilize for interest rates, I think the question is, does somebody want to wait that long, or is it just easier to originate a new loan?
Yeah, I can't imagine that they'd be able to pull that off. I mean, how many links in the chain, looking at your secondary background would be broken as far as assumptions and MBS. And I mean, I don't even know where they would begin. That seems to me to be the worst of the ideas. I mean, it's the best. It's a great idea, but the least likely to be able to pull. I mean, LLPAs, okay, let's strip this, let's add to that. That's done. That might be, the quickest and best idea. And so I want to ask you about first-time home buyers. What is your best and quickest of your best solutions to be able to get more first-time buyers into the housing ecosystem?
Deal with the tax and insurance problem immediately and wage increases to a more livable wage in the United States, right? What's happening with unregulated insurance markets and also markets that have been faced with a lot of environmental climate risk impact is, the taxes and insurance are skyrocketing through the roof. And that's actually one of the bigger things that's making homes less affordable. Everybody likes to point to mortgages are unaffordable. Take the principal and interest components of most mortgages, borrowers can qualify for them. Now add in, insurance that's gone up 66% in the last 4 years, and now you have an affordability problem.
Yeah. I like those ideas. Those are good. So you're not, I don't hear you saying YIMBY. So
Huh.
I'm a
No,
NIMBY person. I'm a not in my backyard person.
yeah,
Which,
but with that said, I don't think about my backyard. I think about everywhere that our business touches.
yeah, for sure. Yeah, I get that. I like from 100,000 feet. That sounds great. But when you buy a house in a neighborhood and you are making some assumptions based on historical appreciation, and all of a sudden there's a conversation about putting a condo within 100 yards of your door, which could bring that value down. Again, sort of like the, this idea of assumable mortgages, like you're breaking something pretty material, when you do
Yeah,
that.
but I mean, look, I think that Director Pulte could use, and you and I have talked about this, right? Could really use some full life cycle experts in a room with some of these ideas saying, okay, if you want to do this, how are you going to deal with this, and this, to your point, that you're going to have to break, change, refine, deal with to make that happen. And then what would be the impact of that from, the perspective of the mortgage industry or not? Even a portable loan, it's going to be seen as a new extension of credit. It's being underwritten, whether you let the borrower keep the rate or not, but then the investor has to be okay with keeping that rate as well, right? So, and to make the GSEs do that is semi-silly, just like the 50-year mortgage, which, by the way, is inherently non-QM, and GSEs can only buy QM loans. So there's a lot of things coming out, on X or wherever it's coming out.
Yeah.
And let's, maybe focus on things that we can do without having to redo complete regulation, except for where it makes sense from a product perspective.
Yeah, I like what you're saying about getting the right people around the table. Like, I think we're all okay with something substantial happening. Like, even if stuff got broken, like, even if we all just decided, you know what, assumable mortgages, like, how would it work? And here are all the dominoes that would fall, and can we fix all these and then we consider that. But this sort of spray and pray idea, like, I don't know how anything is going to get done. And then who are the people in the room? I don't know anyone in the room except for Barry Habib. And it seems like maybe Barry's on the outside of the room looking in now. I don't know. I mean, there are a couple other things I want to cover with you. One of them is this race for the flywheel and for originating platforms to get married to servicers and this all-in-one kind of thing, right? And so my question to you is, looking ahead, maybe not today, but 3 years, 5 years, do you have to have servicing? Do you see a world where you have to have servicing to be able to survive? And if that answer is no, not necessarily, how will those companies survive that don't have servicing?
So I think one of the things that nobody says out loud is that servicing can be the best thing for you, but it can turn against you quickly, right? So having a very large servicing portfolio, if not actively managed for all asset types, not just delinquent or early stage delinquent, right? As much as it can be a benefit for you, it can be a detriment that could take you out as quickly as it benefits you. Have the tide turn like it did in a COVID pandemic, have a lot of things happen, and all of a sudden your cash flows can be very stagnant from those assets. In addition, there's a lot of loss mitigation allowable policies out there that should not exist if the loan types don't exist, because at that point, the assets are going to be less liquid. The other thing I think to keep in mind, Greg, is a lot of the guys that own the majority of these servicing rights also own the mortgages, or they've been securitized by them, either as a co-issue, a deposit share, or on their own shelves. So they have the mortgage and the servicing rights. There are guys that buy just the servicing rights, but that's not the biggest guys out there. So I think that's important too. So how they're performing now, what the multiple is that you're putting on them, is it inflated? Is it not inflated?
Well, who checks that? Who checks that? Because a lot of these companies, claim to be profitable, so they meet their covenants, and maybe they're not so profitable, and they can move that, they can dial that up and down, right? Like, so that is that an area? Did it used to ever be different, or has it always been the same? Like, if you were, would you police that if you could?
So, for example, depending upon the structure of the entity, there will be guardrails in the entities. So, for example, a lot of guys retain third-party services to value their book. Right? When you are an investment fund, an SEC registered investment advisor, et cetera, there usually has to be a third-party validation of how you're marking your books, et cetera. So there are certain policing and guardrails around that. But again, it's going to depend on what's the structure of your entity. Less if you're a private entity, for example. And I think that's an important thing to look into. And if you're going to invest in those entities, make sure you do that diligence, right?
Yeah, for sure. Trying to think if we covered all the ground here. I know you're a fan of first liens as HELOCs, which reminds me, you know, I got into the business in 1997, I think, and the Macquarie loan used to be. So I don't know if you remember that, but I think it was
that's a little different. So the Macquarie loan was very complex. It also had step ups and, you know, restrictions on draws after a certain number of years and things like that. So that's not the first lien HELOC that I'm talking about. First lien HELOC I'm talking about is a 30-year loan with a 10-year IO to full AM conversion in month 120, which allows, even for in a purchase scenario, if the borrower is paid down principal balance, they can again draw from that principal balance. And when you take into consideration that mostly still to this day, that's one of the largest investments that a human has, right? It would make better sense to be drawing from your first lien HELOC than it would to tap, you know, your 28% credit cards.
Especially if it recasts. So if you're paying that down and in that IO period, you end up with a lower payment if you're able to knock the ball, you know, out of the park, right? So I do remember there's one more question I want to ask you, and this is as much for my own edification and clarity as anyone else, because I don't fully understand it. I'll admit it. I don't know everything. I'm not like you. So that's why I'm asking. That's why I'm asking you. I know you don't know everything, but you know a lot more than you've forgotten a lot more than I have remembered. Okay, let's just put it that way, and I'm okay with that. So this the latest thing. One of the latest things we heard was that the 620 minimum requirement was removed from the engines. I guess DULP, whatever. Can you explain what that is and what the ramifications will be? Is this a good thing? Is it a bad thing? What do you think?
I don't actually think it's going to make much of a change because the credit score itself was never really a decisioning characteristic, except for an automatic fail for like DU. You know, it was really taking into consideration what was being seen in the Bureau's reporting itself. I do think, you know, the guides did have a 620 FICO floor. But I think that, you know, you're going to still see, you know, trade line requirements and things like that that are still going to have a sanity check around where a borrower falls within that trajectory. The other thing is, you know, the MI companies are still at a 620. There's rumor they're going to take their allowances down to 600 and certain other things. So right now, I don't think you're going to see monumental differences.
So marketing?
Well, I think it's more, you know, we're making change, you know, coming out of DC and them wanting to send the message of we're effectuating change. These are the changes that everybody's asking us to.
Yeah.
I want to see the sum total of multiple changes come out to be something value positive for the mortgage and real estate industry. And, you know, so far I haven't seen anything that's a big, huge value add. Have you?
Well, I'll say this. I feel like this administration at least talks about us.
Agreed.
You know, I mean, they're floating ideas that, you know, are worth having a conversation, right? I think the previous administration, I felt lost. I mean, there were just onerous fees on top of fees on top of fees, and the cost to produce a mortgage absolutely ballooned. Here we have an administration and a director at the FHFA who's got a builder background. You say what you want about him. It's cool. I mean, like the Pulte name's a big name, and he's out there trying to make stuff happen. Like, you know, and we can all pick apart and split hairs, and I've done some of it, right? The common denominator is getting the right people around the table. We got a great industry with some really, really smart people that understand policy. And I think once that happens, then I think we're going to start to see a lot of substance behind the words. What are your thoughts?
No, I agree with you. I do like to see that they are talking about this regularly, that they are, you know, looking to effectuate some level of change. I do think that, again, to your point, you said it a second ago, we need more of the full life cycle experts and experts in certain components of the industry to get together and partner with the administration, Director Pulte, et cetera, to really bring about the change that, could really help those looking to move into a home ownership scenario, or quite frankly, get out of the homes they're in now and go into a new one.
Yeah. Well, is there anything else you want to add here at the end? Is there anything on your floating around in your mind that we've not covered? Or I know you want people to follow you on LinkedIn. You're pretty prominent on there. You're becoming more and more prominent.
Yeah, no, what I would say is I think this week is going to be a very interesting week in the mortgage business. We obviously just had what happened with regard to the revisions of the disclosures for Fannie and Freddie. Tomorrow, Ackman from Pershing Square, who still owns about 210 million shares in the GSEs, is hosting a live X, presentation about what he thinks should happen with the GSEs. And I think it's going to be interesting to see how the market reacts to that. So I think this week is going to be an interesting week for mortgage in general, and how the administration, Mr. Pulte, et cetera, react to that as well. So I think there's a lot to watch this week.
Yeah, obviously Bill Ackman wants there to be in some kind of an event, right? Because those
Yeah,
210 million shares are going to turn into a lot. I mean, it's already probably would be considered a pretty good investment at this point.
Yeah, I mean, originally he called for the merger of the two entities, so we'll see if that's changed. So far, the PR behind, his presentation tomorrow is that he believes what he's going to present is going to check the boxes on all of the features that the Trump administration's been asking for, and also has context to why he believes that mortgage rate deviation or spreads will not be a problem if he does what he's suggesting, or if we were to do what he's suggesting. But, I think tomorrow we'll find out what he may be suggesting.
Okay, cool. Well, I'll be tuning in. I appreciate you giving me and the audience a heads up. This has been great. We blew through 45 minutes almost.
Yeah. No, look, it's always a good conversation with you, Greg, and I appreciate you having me on. And look, I think we got a lot to get accomplished still in, the mortgage and real estate sector, and let's all get it done and work together to get there. I think that's what I would say with regard to the administration and, those of us in the industry. I'd like to see that happen.
What is going on with that shelf behind you? Can you give us a little color on that?
It's just a bookshelf.
There's a lot happening back there.
Yeah, it's just a bookshelf.
I like that. All right. Have you read most of the books on that shelf?
No, it's actually a virtual background. So I'm traveling, so I have my virtual background back there today.
Well, I like it. I like it.
But I do actually like to read books, so I'll give you that one.
All right. Is there a podcast you like? I like to ask people this question.
I like a few of the podcasts. I would say I really enjoyed my recent discussion with Clayton at Housing Wire on Powerhouse. It was very nice of him to come back to do that interview, so I enjoyed that. And there's a lot of different podcasts that I watch. I like Chrisman, the one that he does with Rich. I think that one can be an interesting one. I've chatted with them on there as well. There's some other podcasts that seem to be cropping up lately, but I feel they're a little bit more scripted than these, right?
Yeah, any outside of the mortgage business that you listen to in your downtime that you'd recommend?
Not one that's coming at the top of my head.
Do you watch a lot of TV?
Not really, but when I get into television, sometimes I'm more of the I don't have time. But then when I do, I get on like a streak of watching a couple different seasons at a time.
Yeah, you binge. We're bingers too in my household.
I'm a binge watcher.
Me too. All right. Well, listen, you've got so much to offer here, and you've given us a glimpse into that brilliant mind of yours. I really appreciate your time, and hope we can do this again in 2026.
Absolutely. I'll see you then. Thanks, Greg.
All right. McGuinness, take care. Have a great Monday, everybody. So long.
See ya. Bye.